Let's read. Marble Co. wishes to calculate its current weighted average cost of capital as part of a review of the company's performance in delivering shareholder value. Dividends per share paid to ordinary shareholders in recent years are as follows. Okay, it's given. The dividend for 2008 is 0.84 cents per share. It's due to be paid shortly. Marvelco has in issue 226 million ordinary shares with a nominal value of zero point 0.5 cents per share and a current cumulative dividend share price of $11.93. Marvelco also has in issue 20 million preference shares with a nominal value of $1 per share and current ex-dividend market price of $2.27. A 25% per share preference dividend has just been paid. Marbleco is partly financed by 6.5% convertible loan notes with a total nominal value of $94 million. Interest on the loan notes has just been paid, and the loan notes have an ex-interest market value of 107.11 per $100 nominal value loan note. At the end of 5 years, the loan notes will either be redeemed at nominal value or converted into 8 ordinary shares of Marbleco per loan note. Future share price growth is expected to be 6% per year. The loan notes are secured on the current non-current assets of Marbleco. Marbleco pays corporation tax at a rate of 26%. What is the first requirement? Using market values, calculate the after-tax weighted average cost of capital of Marbleco. Very simple. Starting off with, we are going to calculate the cost of equity. So in this scenario, to calculate the cost of equity, we are going to use the what method? Dividend valuation method. Okay. So for the dividend valuation method, we need the dividend value. Dividend value is given 0.84, and then we need the what? X rights price. So let's just calculate that. P0 should be equals to cumulative share price is given as 11.93. So cumulative price minus the dividend gives you the X rights. Next, we need the growth. What is the growth? Here we are going to use the historic growth model. Okay, so historic model, whatever. So that is the current year dividend for the current dividend 0.84 divided by the 2004 dividend 0.69 to the power of 1 divided by how many years is it? 2004 to 2005, 2005 to 2006, 2006 to 2007, 2007 to 2008. It is 4 years. Okay. Should be within brackets, then minus 1. So what is the growth rate? 5.04%. Okay. Then we can calculate the KE. Cost of equity equals the dividend D0, 0.84 into 1 plus G divided by D0 plus the growth. What is the cost of equity then? KE is 13%. Very simple calculation done. Next, cost of preference shares. How do you calculate it? KP equals simply preference share dividend divided by the market value of the preference share. So what is the preference share dividend? $1 is the nominal value. A 25% per share preference dividend has just been paid. So that is $1 into 25%. Okay, so guys, important point. So when you're doing the question now, here simply you know definitely, okay, the nominal value is $1, 25% we are paying a 25% dividend. Therefore, obviously the dividend is how much? 25 cents. But when doing the question, you are not supposed to write 25 cents in the, like you are not supposed to type 0.25 divided by what is the market price? 2.27 over here. You're not supposed to do that. Okay. Reason for that being, you have to show the proper working. Okay. So what should you do? Either you have to calculate the preference share dividend separately, or we can put it inside the cell itself. $1 into 25% divided by 2.7. What is the cost of preference shares then? 11%. Finally, cost of redeemable debt. Cost of convertible. It is a how many year loan note? 5-year loan. So year one, we are getting how much? What is the market value? How much are we paying? 107.11. Year one, interest payment is $6.5 because it's a 6.5% loan note. But remember, we have to consider the post-tax interest payment. So into 1 minus 26. In year five, what is happening? Since it's a convertible loan note, you have two options. You can go for cash or you can go for shares. So we put a small working over here, maturity value. So if you go for the cash option, you will be getting how much? $100. If you go for the share option, you will go for how much? Current share price is given at how much? 11.09. Okay. The shares are going to grow at a rate of 6% per year. So into 1.06 to the power of 5. How many shares are they going to get? 8 ordinary shares. Sorry, type that again. 7.09 into 1.06 to the power of 5 to 8. 118.73. So, as a person with a brain, will you choose to go for the cash option or the share option? What will you choose? So, what are you going to write? Since the share option is higher, it is assumed that the investors would choose the share option to maximize their wealth. Okay. So this line is very important. This point is very important. If you just, put 118 over here, what's going to happen is that the examiner is not going to award you the marks for the conversion value. So we'll change this to my maturity value with tell its conversion value. So you will not get the marks. So you have to write down this assumption which we are making. Say we are assuming that investors will go for the share option because it will increase their wealth. Version. So how do you calculate the KD, cost of debt? That is simply the IRR. So how do you calculate the IRR? Equals IRR year 0 to year 5. What is the KD then? Cost of debt is 5%, 5.63%. Next, what you need? You need the market values. So equity, preference shares, and convertible loans. What is the market value of equity? So we have 226 million ordinary shares with a nominal value of zero point 0.5. Each share has a market value of 11.09. So total market value should be equals 226 million. Here we are doing the calculation to the millions. Okay. Divided by zero point 0.5. So you'll get the number of shares multiplied by the market value. Okay. So before doing anything else, because we are doing the calculation not for the whole numbers, we are doing the calculation for the millions. Ideally, the correct thing to do is put a note for the examiner. All figures are in millions. Okay. Now they know. They won't be confused. Okay. There we go. Preference shares. What is the market value? We have 20 million preference shares into 2.27 per share. 45 million. Convertible loan notes. We have how much? 94 million divided by 100 into the market value of 107.1. Total market value. Then what is the weighted average cost of capital? Market value of equity into the KE plus market value of preference shares into the KB plus market value of convertible loan notes into the KD divided by total market value. Okay, that's your answer. All okay with this? So I hope that you all are following along. Okay, when I'm doing the calculation. All okay? Others all okay? This one, this figure. Sakuni, this. You want me to explain this? Yeah. So the weighted average cost of capital is the total cost of finance divided by the total finance. So how do you calculate the cost of the finance? Amount of finance into the cost. So what are we doing? Total equity, market value of equity multiplied by the cost of equity. Next, what we are doing? Total preference shares multiplied by the cost of preference shares. Then total debt multiplied by the cost of debt divided by the total finance. Total equity, total preference share, total loan note. So you're adding everything and you are dividing the cost by that. Okay, so this is the basic calculation. So Sakane, I hope that you have caught up with all of the recordings. Okay, that's how you calculate it. Okay. So if it's not clear, make sure that you are rewatching the recordings. Okay. So this is basic content knowledge. If you don't have this proper understanding, if you have to rewatch the recordings again for the calculation. Okay, Sakuni, are you okay? Requirement B. Discuss the relative merits of the capital asset pricing model and the dividend growth model in calculating the cost of equity. 4 marks question. What do you mean by relative merits? What are they indirectly asking you? When they say relative merits, what are they indirectly asking you? Guys, this require remember in the exam, rather than answering the question, most important aspect is to understand the requirement. You have to understand what they are asking you to do. So here, what are they asking from you? What are they asking you to explain? Guys, yes, your thoughts? No. What do you mean by merits? Merits means something good. Okay, so here, let's read the requirement again. They're asking you discuss important terms. These words you have to know in your head. When they say discuss, you have to write it out. You have to explain. When they say discuss, you have to explain. So discuss the relative merits. Relative merits means advantages of the capital asset pricing model and the dividend growth model in calculating the cost of equity. So what are the advantages or what are the relative advantages of the campaign and the dividend growth model. So mainly we are going to focus on the good things, but slightly we are going to focus on the bad things because they didn't say advantage, disadvantage. If they say discuss the advantage and disadvantage, it should be a balanced sort of discussion. If you say three advantages, there should be three disadvantages. But when they say discuss the relative merits, we are going to just focus on the better aspects of these two models. Okay, so let's just have an opening sentence. Okay, let's just say, okay, two different methods which are used to calculate the cost of equity for company. Okay, so this is just the opening sentence. Will you get any marks for writing this? Absolutely not. No marks. Is it compulsory for you to write something like this? Absolutely not. If you write it, there is no advantage. There is not a big additional mark which you will get. And if you don't write it, you are not going to lose any marks. But I am writing it just so that your answer looks more professional. Okay, so I like to have some sort of perfections in my answers. So therefore, my answer is it's the perfect answer. Therefore, there is an opening sentence over there. So you don't have to worry about it. Now we are going to actually start off with answering it. Tell me what are the relative merits of the CAPM model and dividend valuation model. Give me some points. Hmm. Very good. CAPM takes into account the risk. So for each topic which we are going to discuss, we are going to have a heading. We are not just going to simply write down paragraphs of points. We are going to write it in a structured way. So first thing is risk. So we are going to say, so here the brackets CAPM cuts deviate takes into account the risk of an entity when calculating PE of. On the other hand, the dividend valuation model does not take into account the risk. Okay, that is, so we can say this is the largest weakness of the dividend valuation model. Since the return which the investor expects and the risk of a company go hand in hand. The dividend valuation model ignores this relationship between the risk and the return. Okay, fine. Anything else to discuss? Campaign method is the best method. Yeah, yeah, I know that. But that's not a point. Like you can't say that as an advantage. Okay. Any other points? It discuss why systematic risk is important. Now, Captain does the discussion of systematic risk, although that is something which is relevant for campaign, that is not something which the campaign model put forward. What else can we talk about? Okay. Let's talk about the weakness of the dividend growth model, shall we? One of the weakness of campaign model weakness. Always we are scolding dividend valuation model, no? So let's talk about the weakness of capital. Or else, what's the point here? We can say that the weakness of the capital asset pricing model is the figures which are used in calculation. Okay, namely the risk-free rate and the beta values. In a real-world scenario, obtaining a risk-free rate is close to impossible since there is no security carrying zero risk. Okay, so you all know the definition of risk-free rate means the return which you will be getting on a security if the risk is zero. But in a real world scenario, there is no sort of security which is carrying zero risk. Everything has a risk. You can't say the security has zero risk. If you are saying that, you are lying. So therefore, getting the risk-free rate for the campaign calculation is also impossible. Therefore, we are using a substitute. What is that substitute? Zero risk. Therefore, the return on short-term securities, short-term government securities is considered a close alternative. Additionally, the equity beta used in the capital model is based on historic data. So the equity beta which we are calculating is based on historic data. We are calculating based on historic figures, past figures. So you cannot calculate the future cost of equity using past figures. That is not a reasonable assumption. Okay. Therefore, it cannot be said to be an accurate representation of the current or future risk. So we discussed it a bit. Make I think it's just a 4 mark question. Okay. If you all want to take it down, you all can take it down. If you all are done taking it down, please let me know. Guys, if you all are done taking it down, let me know. Others, shall we move on? Okay. See, explain the connection between the credit hierarchy and the relative cost of the sources of finance. 5 marks. There is just one connection. What is that connection, guys? Very simple. It's a very simple requirement. Don't have to think too much. Very simple. The relationship is there between the two. Can you all tell me what that is? Yeah, how is it connected to the credit hierarchy? Okay. So, guys, remember the credit hierarchy. What does it look at? In the event of liquidation, who gets their money first? Okay. So, there are people ranked at the top. Who is at the top? The debt holders at the top. Secured debt holders are there. Then there are unsecured debt holders. Who is at the bottom? Equity holders are at the bottom. So, in the event of liquidation, the people who are at the top of the credit hierarchy will get their capital returned to them in first. Therefore, there is a higher chance of them recovering their capital. Therefore, the risk which is faced by those who are higher in the credit hierarchy is less. Therefore, since the risk is less, the return is less. That's how it's connected. So we have to explain that simply. Okay. So we can say the credit hierarchy okay, looks is the order in which capital providers get their capital returned to them in the event of liquidation. The company. Debt holders are at the top of the credit hierarchy, while equity holders are at the bottom. Those at the top of the credit hierarchy, such as secured bondholders, unsecured bondholders, etc., would get their capital returned to them first, the event of liquidation, and are therefore more likely to get 100% of their capital to recover it. And therefore, they face a higher risk, sorry, a lower risk, since they face a lower risk. They are willing to accept a lower return on their capital, which results in a lower cost of finance. The money. Okay, done. Next, we are going to talk about those at the bottom. Those at the bottom of the credit hierarchy, such as equity holders, would get their capital once all other capital providers have received it. Yes. Therefore, it is much less likely in an event liquidation, equity holders be able to recover their investment. Therefore, the risk faced by them is much higher than those than that faced by those at the top of the line. Therefore, they will expect a higher return due to the higher risk they are facing, leading to a higher cost of returns. Okay, that's enough. We talked about it. Okay, fine. 5 marks. Is it enough? I don't think it's enough. Shall we talk about preference shareholders also? Those at the middle of the creditor hierarchy, example, preference shareholders could receive their capital after debt holders, but before equity holders. Therefore, preference shareholders face a higher risk when compared to debt holders, but a lower risk when compared to equity holders. Therefore, the return which they expect be higher than the cost of debt, but lower than stock. Okay, that's enough. 5 marks. Enough. Okay. Very simple. Simply you have to explain what is the connection, how the creditor hierarchy is affecting the risk of the investor and thereby it's affecting the cost of finance. Very simple. So easily we got how many marks? 20 marks. Very easy. Okay, not a piece of cake. So FM section C is very easy, very simple. It's a walk in the park. So ideally, you all should be able to do section C done questions within each question within 20 minutes. Maximum 40 minutes you have to spend on section C. Okay. So within 40 minutes, you have to score 30 marks. Section C is like a cash cow. Have you all heard of this term, cash cow? So there are certain products in the company which are cash cows. Cash cows means you can write it out and get maximum amount of return from it. That is cash cow. So in the FM paper, there are certain things which are cash cows, and there are certain things in in business. There is a term which we use dogs. Okay, dogs. Okay, so dogs are what useless products. Okay, so just like that, in the FM paper, you have to identify. Okay, what is the cash cow? Cash cow is the what? Section C. So in section C, you have to maximize the amount of marks. So, but you can't spend too much time also. If you spend too much time, section C is only 40 marks. If you spend 1.5 hours on section C to get the remaining 20 marks, you will suffer. Okay. So, although section C, as I'm saying, you have to maximize your number of marks here, you can't waste time. So, I would say within 40 minutes, you should be able to ideally complete FM section C. So, within 40 minutes, complete it and you have to earn at least you have to score 30 marks. If you score 30 marks in section C, from section A and B, scoring 20 would not be that difficult. Therefore, please make sure that you all are very good in FM section C because it is the easiest part of the paper and the area which you can pass, in the area which will, result in you passing. If you do not perform well in FM section C, it will be difficult for you to pass. So, with that being said, this question is done. Therefore, the class is also done. But I will be uploading a few extra recordings for you all to watch because as I feel one question is not enough. But I don't want to practice the question. I'm getting fed up practicing it again and again. I can't practice the same question 100 times. So since I have already discussed the other questions in the previous QBR sessions, I will be uploading the recordings. Simply what you all have to do, take those recordings and watch it before next week. So once I upload those recordings, I will drop you all a message in the WhatsApp group. Please make sure to watch the recording. Okay. And one more very important thing. Tomorrow you are having the interim mock one. Okay, as I've informed you all. So make sure that you all are watching, you all are attempting the interim mock. And one more additional fact to mention, from next month onward, from the month of August, we are going to be having the classes twice a week. So twice a week in the sense the overall duration is not going to change, but slightly it will increase. So the timetable has already been shared in the WhatsApp group. So please make sure that you are checking the FM class timetable and making sure that you are clear on what days which we are having the classes. Okay, so finally don't tell sir you did not tell that the class is on this day, all of that. No, timetable has been shared. All of the necessary information is shared in the WhatsApp group. If you all are unable to read, it is not my problem. It's your fault that your eyes aren't working. So you all are there in the WhatsApp group. So those who are there, please make sure that you all are properly reading the messages. Open your eyes and read them. Okay, without being lazy. So with that being said, we are done for today. If you all have any questions, you all can ask me any doubts, you all can ask me any concerns, you all can communicate that. If not, then you all can leave the meeting. Thanks for joining today. See you all next week, guys. So study hard. Your deadline is on the 28th. You have to book the exam before that. And you have around 1 month remaining for preparation. So FM is an easy subject, yes. Every single day I tell you all. So it might be PM QBR class, I don't tell this. So in the PM QBR class, those who have attended the PM QBR, you all know. What do I say? PM is a difficult subject. PM you can't pass. PM is very difficult. That's what I say. So that is the truth. To be honest, that is the truth. But FM is an easy subject. That is the truth. But FM will be a difficult subject if you don't study. So if you want to pass FM, you have to do what I'm saying. Properly follow the content class, properly follow the QBR class, properly attempt the question, properly attempt the mock exams. If you don't do these stuff properly, definitely you will pass. But PM, even if you do these stuff properly, sometimes you might not pass. That's why PM is a difficult exam. But FM is easy. You do a few things, you can pass. So those few things, make sure to do it. Since you are spending your money, it's not a loss for me if you are failing. I'm not facing any sort of loss. I will get paid extra because you all are again and again coming to the classes, no? So yeah, but please make sure that you all are focusing and studying. Okay, so if there's anything you all can ask, if not, you all can leave. Thanks for joining. See you all next week.